Next week is Trump 2.0, and we have Jim Welsh of Macro Tides to break down all the data, all the markets ahead of what could be a historic week in the market. Hello, Jim. Happy Friday to you.
Happy Friday to you, Blake.
TGIF. Next week is going to be a busy week. I know you want to break down the data
Sure.
that we've gotten. You want to break down some of the markets and what could happen. But I want to ask you this: what words of wisdom you've been around the markets for quite some time? So, what words of wisdom do you have to offer traders and investors as we are embarking on Trump 2.0?
Yeah. Well, the main thing for me is there's a lot of known unknowns. So we know he's going to do tariffs. What we don't know is how big. Is it going to be a shotgun approach, like a flat 10%? Or is it going to be, all right, we're going to pick specific sectors and target tariffs on those specific sectors? So for me, it just means being reducing exposure until we know what more about what he actually is going to do, give markets a chance to react to that news, and then make an assessment in terms of, all right, is it time to look for a reversal or continuation in some of the trends that have been in place for the last, well, since the election?
So,
And so I'm not going to place a bet on what he may or may not say and what how markets may or may not react.
well,
That doesn't make sense to me.
yeah, right. That makes a lot of sense to me as well. I fear, that if you look at like volatility, the VIX is pretty low at this stage in the game. As we head into, what most of us know is, hey, there's going to be some tariffs coming in with the new Trump administration, and probably a lot of executive orders that could really move the markets. Do you think the markets are a little too complacent at this point?
Potentially. Again, it comes down to what is the thrust of those executive orders. And at the same time, think about it. I think we talked about this in the last week or two, Blake. President Trump wants to increase oil production from 13 million barrels a day to 16. That's part of the 3-3-3, 3% GDP, 3% deficit as a percent of GDP, and adding 3 million barrels of oil a day. So he can give an executive order in terms of, okay, these are the steps I want to take to get to that goal. But again, then you have the other side of the trade. The oil companies have, for the last 5 years or so, embarked on less oil exploration, paying more in dividends and more in stock buybacks. Are they going to abandon that? I don't think so. We've got trading partners. He'll make an announcement in terms of whether it's a blanket tariff or target specific tariffs. Well, no matter what he says, the other side of the equation is going to push back in terms of this stuff. So I think there's the potential where you could get a knee-jerk reaction to some of this stuff, Blake. And then it's like, well, wait a second. Just because he's snapping his fingers isn't going to make this stuff happen. And I think that's the other side of that knee-jerk reaction is where the real trades will present themselves.
All right, all right. Sounds good. I was going to ask you this too, and I didn't even mention it before I hit record. So sorry if I'm going to catch you off guard.
Oh,
Did you get a chance to watch the Besant?
I did.
Okay. Did you have any initial thoughts right off the top of your head?
Well, again, they stake it as a priority in terms of extending the 2017 tax cuts and everything entailed. He basically said, well, if that doesn't happen, we're facing a calamity, which personally seemed a little bit of, like excessive, I mean, like, really, the world's going to come to an end. But I think he toed the line in terms of what they're what have been spelled out by Trump in the campaign, what he himself has said, very consistent. But they're putting a great deal of emphasis on extending those tax cuts. That probably that's the second half, I think, of this year, Blake, for a lot of different reasons.
All right. Well, fair enough. Let's jump into your charts, and I think the first chart that you brought, Jim, is you brought CPI, and here is your CPI breakdown. You
Uh,
were expecting CPI to stay pretty hot, or at least in line. It came
well,
in
flat,
a tick
basically
lower.
not provide much relief. Okay.
Yeah,
And so what the key that people reacted to was that the core rate dropped from a 3.3 annual rate to 3.2. But if you extend the numbers out to three decimal places and the Bureau of Labor Statistics only does it to one, but when you get the actual numbers, the real number was 3.248. So if it had been up 200ths of a basis point, it would have been 3.25, and then they would have rounded it up to 3.3, showing no change. But because it was 3.248, they rounded it down to 3.2. So at the same time, we can see that the actual number for headline CPI ticked up from 31 to 39. And yes, the core came down 8 basis points. So my point is, are the members of the FOMC going to react to this number the way financial markets reacted? I don't think so. I think there was an overreaction. As we talked last week, I think relief is definitely coming because the next 4 months, when we start getting the January of 25 reading and so forth, for 4 months, you're going to subtract 140 basis points. So uh, the assumption I have made is that, well, if it comes in at 25 basis points, you're going to see the year over year number just climb by 0.4%. So the headline number came in hot. We're seeing gasoline prices starting to tick up and so forth. So my point is, there's relief coming. It may not be quite as much as I think is likely, because you need those month over month numbers to come in more, uh, manageable. Again, in the Fed, you have a group of people who want to see more proof, and there's people who are, leaning more towards cuts. Like Waller gave a speech, or was interviewed on CNBC yesterday, and he was fairly dovish. Again, he's looking at the takeaway values for the next 4 months and shelter, how that should ease up. And he
yeah,
thinks, hey, I'm pretty confident we're going to see inflation trend down, so I'm on favor of rate cuts. And he wouldn't rule out the March meeting. So absolutely no cut at the January meeting that we're going to see in a couple of weeks, but he still has it in his mind. Well, it's possible depending on the data. So anyway, I just wanted to show the reaction to the tick down in the core year over year number. It's like, okay, most people don't look at three decimal points. They just look at the headline. Well, the annual went from 3.3 to 3.2. Woohoo!
yeah,
So
yeah.
all
All
right,
right,
there
yeah,
should
and
be a
and that
chart in
was, I
there.
mean, the market obviously reacted to that, and it shifted
Yes.
this chart that you see here, right?
Yeah. So this is the odds of a rate hike this year. So prior to the CPI, it was up to 35% of people starting to think, well, maybe the Fed will actually raise the funds rate. Back in September, when the Fed cut the funds rate 50 basis points, it was 2%. So my point in Monday's weekly technical review was that, hey, when you look at this kind of a shift, people have, I think, gone way too far in terms of, okay, the Fed may actually raise rates. I don't think that's a realistic possibility this year at all. And to me, the reaction to the CPI kind of reinforced that, yeah, people got carried away about the idea of a rate hike. Forget about two rate cuts. We're talking rate hike maybe.
Yeah,
And so to me, that modest slight improvement in the CPI caught a lot of people, I think, flat-footed and short various markets. And I think that's also contributed to, the rally we saw in bonds, the rally obviously we saw in stocks. So I just wanted to show the contrast in terms of, hey, people got to me a little crazy thinking that the Fed would be raising rates. And again, going back, if you look back to April, you can see it was about 27%-ish.
yeah,
Well, that's when Treasury yields top. So, people, these are sentiment indicators. and they reflect what markets have been doing and people projecting what they've been doing into the future. And, in September, they go, oh, treasury yields are going to keep coming down. We don't have to worry about anything. And now we see bonds sell off fairly significantly. Oh my God, the Fed's going to be tightening. So, when I see these kind of numbers, it always makes me say, all right, let's look at where markets are, because this to me indicates or increases the probability that treasury yields are probably closer to a high as opposed to, oh, I'm going to expect a continuation of the trend.
So Jim, what you're saying here is the pendulum is definitely swinging, and these expectations might be a little bit too aggressive at this point.
Absolutely.
All right.
Absolutely. And if I'm right, inflation eases a little bit. And the other thing that's going to happen on February 7th, and we'll talk about this maybe more next week or 2 weeks from now, is the annual revision of jobs coming. And the Philadelphia Fed, I think we talked about this maybe 2, 3 weeks ago, does an analysis looking at state unemployment data. So really getting into the weeds. And what they found was job growth was far weaker. In other words, 0.8% instead of 1.6. And then Waller in his comments yesterday, kind of said, well, it could be 50 to 60,000 a month weaker. So that would eliminate about 30% of all the jobs we thought had been created. So my view has been is that you've got people expecting rate hikes. Oh my God, the labor market is strong, so strong. I think we're on the doorstep of getting data that said, whoa, wait a second, the labor market wasn't as strong as we thought. And we are going to get some measure of inflation relief over the next 4 months because the takeaway values from the first 4 months of last year were really high. Remember,
Yeah.
we got like four, reports in a row. And look at that's why, if you go back to January, there was like what a 6% probability, and then it ran to 27%, all because of those bad CPI reports. That's going to reverse to some extent in the next 4 months.
Okay, the next chart you brought is term premium. So tell us what this chart means and what it represents.
Okay, very simply, it's basically taking the 10-year yield and effectively comparing it to the 90-day T-bill and saying, all right, what premium should I have above the effectively risk-free 90-day T-bill to reward me for holding treasury bonds? And this is, again, one of these theoretical concepts. And in 2013, the three people from the Federal Reserve came up with a model, and this is what it is. To me, this is nothing more than another sentiment indicator. Look, in 2020, the premium was negative by more than 100 basis points at a time when the 10-year Treasury yield, I think, got down to 55 basis points. And then you saw the big spike up into 2021 as Congress was spending a lot of money. And then as inflation took off, look at it, it's amazing. Inflation is going nuts and the term premium is negative, and the Fed's been raising rates. What I'll also point out is if you look off to the left, 2016, the term premium jumped almost 100 basis points after Trump was elected. Now we look at where has it gone from September of this year? Well, from about minus 30 basis points, and it hit 66 basis points a few days ago.
Yeah,
100
so
basis
about
points.
that 100 basis points then.
Yeah. So to me, this is again another sentiment indicator showing that people are really worried about tariffs, how much they may affect inflation and so forth. And what happened in 2018, after the tariffs went into effect, look what happened to the term premium during 2019. So again, this is to me another indication that investors have gotten really worked up about the risk of inflation. Um, the Fed's not going to be cutting rates, all that kind of stuff. And so it's a sentiment indicator that suggests to me, again, that we're in the zip code of a high in treasury yields. Now, we need more proof. We continue to get economic data that's really pretty solid, which doesn't
Very,
surprise
very.
me.
Yeah.
Yeah, it doesn't surprise me. I mean, there's optimism on the business front that, okay, Trump's coming in and they're going to really lower regulation. much more pro-friendly business, and that's created optimism for a lot of CEOs.
Yeah, I mean,
And
look
so,
at the jobs report. I mean, that's I think a clear representation of positivity, Trump bump, if you will.
yeah, and industrial production was up pretty strong, you know. So, again, these are all things that are happening that are a headwind for treasury yields coming down. But, I just think that when the dust settles, when I look at enough of this stuff, I just can't be bearish treasury bonds right here. It just leads me to think that I got to be looking for a trading low in treasury bonds. Um, and we're not quite there yet, but maybe this week we got the first signs of that, which we'll cover when we talk about TLT.
Okay, well, first before we get to TLT, we're going to talk about the dollar, and
Yep.
this is a big one to me, just because I think it's going to be such a binary move if Trump actually enacts, let's say his
Yeah.
bite is as scary as his bark,
Right.
and he imposes some very nasty tariffs. This chart can look dramatically different come next week.
Yeah, yeah. I mean, again, we're seeing signs that it's rolling over, but it's still above that blue trend line. The 5 and 13 exponential moving averages are still constructive on a short-term basis.
Sure.
So if he goes full Monty, could the dollar have another pop? Absolutely. And remember, everything for Trump is negotiation. So when you start a negotiation, you always ask for more than what you're willing to accept because you want to make sure you get what you're willing to accept. And you want to let the other person feel like I asked for 10, but in reality, I'll be happy with 6. And now we negotiate and you get me down from 10 to 6. Well, you're going to feel better about it. You're going to walk away thinking I got something out of it. I still got 6. All right, more than half of what I was asking for. And so there is a risk, Blake, that coming out of the box, there'll be this negotiating issue of asking more than what we're willing to accept for the dynamics I just described. But technically, the dollar to me looks like it's setting up for a pullback. I think once the dollar tops, the decline will ultimately be fairly significant, but we're not there yet.
You keep saying 90s, and I'm like, I don't know how that's going to
It's
happen, but
hard to
I guess
believe,
in a
right?
Trump presidency, anything could happen.
Well, again, he favors a weaker dollar. And I almost put a chart today showing that when the dollar is down 5 to 10%, the percentage of companies in the S&P that exceed earnings estimates is like 60, 70%. Whereas when the dollar is up 5 to 10%, that percentage drops to be, 30, 40%. So there's real world repercussions. And from his standpoint, idea of getting more production back home, increasing jobs and so forth, a stronger dollar works against that.
Yeah, that makes sense. All right, the next chart, Jim, you brought is gold. Gold's looking pretty constructive, wouldn't you say?
The problem I have with gold, and I may be entirely wrong here, is the rebound from 25.41 looks corrective. Look how choppy it is. Now, does that mean gold can't go to a new high, a marginal high? No. It could be that you wave A down to 25.41, and we're doing all this choppiness as part of a wave B that then would be followed by a C wave decline. So, my take has been, I think, my take was correct in terms of looking for a correction back last October. And since then, it's been all right. I think we're going below 25.41 before wave 4 from the low back in 2022 is complete. So, in other words, that high at 27.89 was wave 3. We're in a wave 4. And when wave 4 is done, we're going to new all time highs. I'm just not convinced that even a breakout above 27, call it 25, will represent now we're on our way to 3,000. I just not there.
All right.
Positioning sentiment are still heavily bullish, which is again is another contrary opinion. If people are all positioned for the upside which is unusual that positioning didn't taper during this choppiness.
Yeah.
In fact, people are still bullish. That's just not a normally a good thing. So,
Well, this would be a great time for us to take a pause for our sponsor. Your sponsor is Mr. Jim Welsh from Macro Tides. If you like his content, make sure you give him a thumbs up. Jump down in the comments down below. Tell him how important it is for your preparation of your trade week every week. And you can get a hold of him at macrotides.com. Okay, back to our regular scheduled program. Jim, let's take a
you
look.
did that very well.
Thank you. Thank you. We're going to take a look at TLT. So you've
Yep.
been looking for a bounce, and we're finally starting to see some signs
Yeah.
of a potential bounce here. But again, this is one of those things that could change quite a bit next week.
Right.
What are you
Right.
thinking here?
Well, my take has been that we were oversold, so a bounce was likely, even if the trend in Treasury yields is ultimately going to be higher, that we would see at least a bounce, and we're getting it. And so that resistance initially at 87, the blue line, a little bit over 88 is the red line, and you can see the RSI. It was comfortably below 30 at the bottom panel and
Yeah.
it's bouncing toward mid-range. So we're working off that oversold condition. So my take here is that this is constructive in the sense that we're finally getting a bounce, but the degree of selling pressure and how unrelenting it has been, for me, I got to respect that, So I need to see more signs that either wave B, which is the blue B there underneath it, is complete. And again, the bigger picture to me has been is the low at 82.42 and the rally to 100 last December of 23 was wave A. And this has been a very drawn out A, B, C for a wave B, and then a rally above the 101.14. Let's not forget, TLT traded at 179 and change in March of 2020. 179 down to 82.
Jim, this is
So
the correction in the bond market. I think bond traders that I've been talking to for the last 2 decades had been finally waiting for. It finally it came true. I mean, but it literally it all happened within 4 years, as you pointed out. But I've
yeah,
known bond traders that have been expecting this move literally for 2 decades, and it finally happened.
yeah,
So
yeah, it finally happened.
yeah,
So again, my take has been is that's an enormous decline.
yeah.
179 to 82, a 382 retracement, which is not a huge retracement, is 119. All right. So I have continued to believe that this correction is the midpoint of this counter trend rally. So that if we get a C wave above 101, and let's say it goes to 105, 109, ultimately, I think Treasury yields are headed much higher. The 10-year, 7.5% or higher. Why? Because that decline from 179 to 82 is a very clear 5 waves down. So in October of last year, I'm like, okay, we got 5 waves down. We're going to get a bounce. We got, a very strong bounce from October to December. I still think there's more to the upside, but for that to happen, Trump can't go full Monty on tariffs and really have an inflationary impact. And we need to see the inflation ease a little bit. You need the economy to slow. I mean, in other words, you need what have been tailwinds to reverse and become what have been headwinds, pardon me. You need to reverse to become tailwinds. So to me, we're at a very critical juncture. And somewhere along the line, Blake, what Besant talked about is the seriousness that we need to get government spending under control. And if a credible approach is provided, um, that might give bond investors more confidence than to be intimidated by the potential impact from tariff inflation. So we're at a critical juncture. If, hey, That counter trend rally ended at 101.64, and we're already into that next phase of yields going up on their way towards 7.5 on the 10-year. I can't imagine that would be that would be cataclysmic for the economy.
Sure. All right. Well,
Yeah,
I think yields at 7% would be. And that's me personally. I think it would be, but we'll we'll see if we could get there. Jim,
yeah,
this is your last chart, which is the S&P, and I
yeah,
actually my drawings are very similar to yours. Looks like we have an upside breakout today, going into a
yeah.
historic
Next month, yeah,
inauguration.
yeah,
So,
yeah,
what do you make
yeah.
of this? Are we going all-time highs?
Well, I think the probabilities have always been pretty good. I was expecting a pullback, and then the nature of the pullback would
Whoops, my bad.
instruct
Keep going.
us in terms of new highs being retained. If you look at the way the S&P pulled back, unbelievably choppy. So that looks corrective. A few weeks ago, I had a target of 57.82, which is nothing more than, hey, the length of the first drop, the rebound is 6,050. You can get down to 57.82. It got to 57.73. So this whole correction looks corrective. And from the low we saw on Monday at 57.73, with today's rally, looks like five waves up to me. Now, this is a 2-hour chart, so it helps see what's under the surface as opposed to just looking at daily charts. What this implies is five waves up. All right, we're near a short-term high. Look for a pullback. I think potentially under 59.50. And what should follow then would be a move up to new all-time highs. There is an Elliott wave pattern where you got A, B, C, and then you get an X wave. X waves are fives, and then you get the C wave coming. So I don't know that we're out of the woods yet, but just looking at what we can see in front of us today, I think the idea of new highs unfolding have increased.
Well,
We got
I mean, and
a
that
corrective. Yeah.
I was going to say, and that could be as early as next week if we have, maybe Trump doesn't come out with both guns blazing, and the stock
Yeah.
market would actually like that.
Uh, yeah, probably. I'm looking at that five wave. If we're going to new highs, that five waves represent wave one of wave five. The pullback under 59.50 would be wave two of five. And then you'd go into a third wave. And so that implies a target of probably 62 to 6,300, maybe, if that pattern analysis is correct. So to me, it comes down to look for this pullback and look to be a buyer of that pullback in anticipation. So there might be a knee-jerk reaction where the dollar pops, treasury yields sell off, stocks sell off, and then it's like, well, okay, let's give it more thought. And we see the dollar finally put in a high and bond yields top out, and stocks, I think, would benefit from that. The broad market has been reacting negatively to higher treasury yields, like the Russell 2000, cyclical stocks, and so forth. So if we're going to get a broad-based move, you got to have treasury yields come down. We just can't have the Mag 7 stocks carrying all the weight at this point in time. That's
Right.
my
Which
view.
they have been for quite some time.
Well, especially over the last 4 to 6 weeks.
Right.
I mean, the
All
80
right.
line peaked November 29th and was weak and hit a new low just, a handful of days ago.
Sure.
So, yeah, anyway.
Well, Jim, next week, like I said, I think it's going to be pretty historic from a volatility standpoint.
Yep.
I think it makes sense for all of you traders at home just to, trade small, wait for the data, the news to come in, let the dust settle a little bit before you start getting too directional in the market. Probably going to be a lot of knee-jerk reactions, a lot of volatility, and you know what? Next Friday, Jim's going to be here to help us break it all down and what we've seen. And let's see if these charts change a lot between now and next Friday. I'm assuming they're
Yeah.
going to.
Well, they always do, Blake. It's a matter
Yeah,
of degree.
that's true.
As
Good point.
JP Morgan once said, prices will fluctuate.
Well, guys and gals, if you've enjoyed this video, make sure you give Jim a big thumbs up. Jump down in the comments down below if there's anything that you want to add to Jim's commentary. And Jim, I want to thank you very much for a great video and thanks for prepping us. I'll see you next Friday.
You got it, Blake. Stay well.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.